accrual every time, then it'll be easy.
Yeah. Okay, so guys, what we're going to do right now is I'm just going to spend 15 minutes reviewing what we did in Chapter 3. So in Chapter 3, we are talking about adjusting accounts. Most of what we've done up to Chapter 3 is go through ways in which we analyze transactions and then record them in the journal entries. In Chapter 3 gave us an understanding that there are accounts that we might not have original documents for, but that based on depreciation or based on reviewing our supplies in the inventory or based on determining that we maybe have payroll that isn't going to actually get paid till the next month, but we need to accrue payroll, we have to create some adjusting journal entries. And so we started out talking about certain concepts you really need to know. What is net income? Net income is revenues minus expenses. That's simple. Revenues are monies coming in and they increase our owner's equity. It's like income that comes in that goes, increases our owner's equity. Expenses are resources that go out that decrease owner's equity. Then we talked about continuity, meaning we always have the assumption that this business is going to continue in the near future. And periodicity means we create income statements based on a period of time. Sometimes it's a month, sometimes it's a quarter, and sometimes it's a year. And then we talked about accrual accounting, meaning we try to match our revenues with our expenses, not necessarily when we pay them, but when we incurred the expenses. So then from there, we talked about how companies use the accrual method. The accrual method is different than the cash method. The cash method of accounting is what a lot of us do with our own personal, income. We show it as income when we get the money, when we actually receive our paycheck, and we show expenses when we actually pay the expenses. But in accounting, the accrual method means that we show revenues not when we receive the money, but when we complete the service or actually sell the product. And with expenses, we record expenses not when we pay the bill, but when that expense really has incurred. Okay? So, and we'll go on because we have different examples here. So then, with cash basis, it's only based on money in, money out. With accrual accounting, it's based on when we either earn it or when we actually use that expense up, not when we pay for them. Then from there, we started talking about when is it we really recognize revenue. Well, we recognize revenue when we've completed the service that we told them we were going to do, or we actually deliver a product. So for today, I did about 20 tax returns. Probably 10 of them, I'm waiting for more information. Let's just say they still paid me today. Technically, that money is not my income. I'm just kind of holding their money. It's not until I finish my service and I say, here's your tax return, that I really can record that income. Even if they paid me, it's really a liability to me because I haven't done what I need to do in order to show that as income. Now, some of them I did complete today, so that is income to me. But the ones I didn't complete, I can't finish. I can't show that as revenue. In the same way, expenses aren't incurred when you pay for something. They are incurred when you actually use it. Sometimes we pay things way up front, like we pay insurance for 2 years. But we really don't use insurance until each month goes by. And And so even though we might pay a 2-year policy up front, it's not an expense until that month's over, and the next month's over, or the year's over, okay? And so even though in that case we paid it before we used it, we have to show it as an asset, a prepaid insurance account, until we use it up, okay? And then we can show it as resources that have been used. There are other times in which we maybe have a utility bill. Why do we have a utility bill? Because the meter went running and we got the bill that said you used up this much energy this month, you pay this. We might not pay that utility bill for another month, but that utility bill has incurred. We've used up those resources, and we can treat it as an expense in the period we used it, not in the period we pay it. So what we tried to show in this chapter are some examples of these adjusting entries. We were looking at some examples of what we call deferrals or accruals. Sometimes we make expenditures that benefit more than just one period. So when we make an expenditure that benefits more than one period, when we make that expenditure initially, we treat that cost as an asset, because they're usually prepaid. We've paid them in advance. So we have a future benefit. So then what we do when we actually accrue or pay that expenditure, we of course debit our prepaid asset, we credit cash. But then at the end of the period or the end of the year, when we look and see how much we've used up, that's when we'll create an adjusting entry to show our debit then to the expense and the credit to that prepaid asset we used up. So types of prepaid expenses we talked about can be rent. We prepay 3 years of rent ahead of time. Well, we treat it as a prepaid rent account until we use it up. Then when we use it up at the end of the year, we then make an adjusting entry to debit expense account, rent expense, and we credit our prepaid rent because we've used some of that up. We do the same with supplies and insurance. So this basically showed us that when we initially pay the bill, we'll debit our prepaid asset, credit our cash. Then as we use it up, we then credit our asset account to reduce it, and we debit our expense account. So we had an example. Design studio paid 2 months rent in advance at the beginning of July. The advance payment resulted in an asset, the right to occupy the office for 2 months. As each day in the month passed, part of the asset's cost expired and became an expense. But by July 31st, 1/2 of the asset's cost, or $1,600, has expired. Just because of time, it's no good anymore. We've used it up. So we talked about, initially we showed a $3,200 debit in prepaid expense. But at the end of July, we've used up a month. So we credit our prepaid expense here because we've used it up, it's no longer there, and we debit our expense account to show that is a resource that we've incurred in the current period. So our journal entry would be a debit to rent expense, a credit to prepaid rent. Then we talked about purchasing supplies, same concept. How we have these supplies, we purchased $5,200 up front. So we purchased up front resources, but we haven't used them yet. But then at the end of July, we look in our inventory and we go, wow, we don't have $5,200 left, we only have $3,660 left. So we need to adjust those resources we've used up. So we take the difference, or $1,540 worth, and we show that $1,540 is no longer a resource. It's no longer an asset. It's used up, so we reduce our asset, and by that same amount, we debit our office expense. That is an expense that's been incurred in the current operating period. And our journal entry would be increasing our expense account and reducing our office supplies because we don't have it anymore. Then from there, we talked about sometimes we purchase assets that have a useful life of 5 or 10 years. And we show it on the books as an asset, but then over a period of time, just because of time, wear and tear, mileage, use, it's going down in value. And the way we handle that going down in value is allocating some of that value to something we call depreciation. And so the way we calculate that depreciation is by determining how long the life is of the asset, and then each month or each year taking a portion of that and writing it off. And the way we write it off, instead of reducing our asset by that amount, we create this, what we call a contra account, or accumulated depreciation, to show that money, that amount of that asset we've used up. So this example, on July 31st, Blue Design Studio records $300 of depreciation of office equipment. So we basically are going to use up $300 of the $16,020 we show as office equipment. And the net is what we show on the balance sheet of what's the carrying value or the book value of the asset. So even though we initially show our asset when we buy it of $16,320, when we go and show that we're using up a piece of it, instead of going against our office equipment as a credit and reducing it that way, we create a separate account called accumulated depreciation on each item, and we credit it, and our offsetting debit is called depreciation expense, which is a current expenditure in the current operating cycle. So this helps us to see another adjusting entry we do at the end of each period to help allocate some of that amount we've used up in assets against accumulated depreciation and depreciation expense. Now, other types of adjusting entries relate to things that have incurred but we haven't paid them yet. Sometimes we have wages. Let's say the end of the year is December 31st and it's on a Wednesday. And pay periods always happen on Fridays. So we need to, and those wages have incurred. People have worked. It's just we haven't paid them yet. But to really accurately show the financial statements to be true, we need to accrue those wages of people that worked, but we haven't paid them this year. Now, we're going to pay them in 2 days, but it's not this year. So we have to accrue expenditures that have already incurred, but we haven't paid them. And then we have to show that we owe that money. The same is true, like with utilities I was telling you about earlier, or interest. If you have a loan at the bank, you pay that loan once a month. But if you've accrued that interest on December 31st, but you're not going to pay that note until January 5th, we need to show how much of that interest is used up in December. So these type of accrual expenditures basically allow us to show an increase in an expense and an increase in a payable. So the other one will reduce an asset and increase an expense. These types increase expenses and increase payables. So we had an example of needing to pay wages. So we show on July 31st that we have accrued $720 of wages, but we haven't paid them yet. So we show a journal entry to show a debit to wages expense of $720 and a credit to our wages payable, because we need to pay them, of $720. That's a type of accrual expense. Yes?
I seem to terribly struggle with my debit and my credit determining, does debit always go fast first?
Yes.
Credit goes second?
Always.
And I get the two of them. I'm very dyslexic, but I get the two of them always mixed up.
I do the same thing.
Debit is always left. Credit is always right. Left, right. So the left side is always the one you're going to do first. Left is always first. Think about it this way. Left is closest to where you begin writing. Okay? You see here how wages expense is going to be the debit.
I get those two mixed up too.
And okay, another thing to know, to increase an expense, you will always debit it. Expenses always get debited. To increase an asset, you always debit it, right? To increase revenue, you always credit it. To increase payables, liabilities, you always credit it. To increase owner's equity or owner's capital, you always credit it. Does that make sense?
What she's saying, though, is when, we're doing the homework, for some reason we get mixed up and we write it the wrong way. I've caught myself so many times. I get all the homework done and I start bouncing, and I got them just backwards.
But guys, that's why you're doing homework. Okay? That's why you're doing homework to work, to trial and error. I would be shocked if you weren't getting them messed up.
Yeah, and I can't, it seems so logical, and then all of a sudden I get done and I feel real confident, and I've got the concept in my head, and then those little wordings like explaining, that it's just this concept that just is struggling, but it's getting better.
Good.
It's getting much better.
Good. And guys, what we might do this week is we might continue with this review and start Chapter 4, but not necessarily finish it. Let's just see how we do. Because Chapter 4 is as crucial as the first 3 chapters, and then after that it gets easier.
That's what you said about 1, 2.
Stop it.
Come on now.
But guys, I would rather put more time in grasping this, and then if we have to combine a couple chapters, we combine them. So what? Okay? Because this is what's most important. Okay? And I really want you, like with Chapter 4, just listen to it, review it, just sink it, get it sunk in as much as you can. Okay? It's more important that you get these first couple chapters cemented, because then everything else will start flowing easily. Okay? So I know we're limited as far as 8 weeks, but those of you, if we got to take an extra week or something, I don't have a problem doing that. Okay? I mean, technically we're not supposed to, but I don't care. I don't have to get grades in within a certain time. You know what I mean? I don't have to get grades until May. So we'll do whatever we have to so it all sinks into you guys. We'll do whatever. So basically, another type of adjustment we talked about is kind of what I was talking about earlier with getting money but really not completing the job. Unearned revenues. If someone gives me cash, but I haven't really done the work yet, my cash increases, but I get a liability that increases. That really isn't my money till I earn it. So unearned revenues are where someone gives you cash up front, but you haven't earned the work. You haven't completed it. And so sometimes what happens is at the end of the period, you have these unearned revenues sitting on your books, but you've actually finished the work. So at that time, we need to show the work's been finished, and we need to reduce that liability account and now show it as revenues because we've earned it. We don't owe it, okay? So this good example tells us during July, Blue Design Studio received $1,400 from another firm as advance payment for a series of brochures. By the end of the month, it had completed $800 of the work of the brochures, and the other firm had accepted the work. On July 31st, Blue would record the performance of services for which $800 cash was received in advance. So think of this, guys. They really received $1,400 of cash in advance. But $800 of it has now been earned. So what we'll do is we're going to show that $800 is now earned. We're going to reduce or debit our unearned design revenue, our liability account, and we're now going to credit design revenue for $800. It's no longer something sitting on our books that we owe somebody. We've completed it. So we reduce our liability and we credit our revenue. It is now earned income. So we debit or reduce our liability by $800 and we increase our revenue account by $800. So basically, here's another one. During July, Blue Design Studio agrees to create 2 advertisements for Maggio's Pizza Company and to finish the first advertisement by July 31st. By the end of July, Blue has earned $400 for completing the first advertisement, but it will not bill Maggio until the entire project has been completed. On July 31st, Blue records the accrual of $400 of unrecorded revenue. So this isn't where they gave us the money first and it's a liability. This is, we're not going to bill them until all of it's done. But technically, we have already earned $400. So what we would do in this case is show at the end of the period $400 of our revenues have been earned, but we haven't billed them yet. So we're going to debit accounts receivable, which is an asset, to show we're due this money. It is a future benefit we are going to receive. So this is a way in which we can book our revenues because we've earned it, we've completed a part of it, and we can then debit a receivable because we know that money will be coming in. We would debit our accounts receivable for $400, and then we would credit our design revenue for $400. So what we do after we've done all these various adjusting entries is then we go and create what we call an adjusted trial balance. And this adjusted trial balance is just like that first trial balance except the changes. We show in all of our accounts listed, and we show the debits, balances with debits, and then we show all the balances with credits, and we total them. Now, when we create an income statement, we determine only the accounts that are part of an income statement. Those accounts should be revenue accounts and expense accounts. And quite honestly, they'll be all the accounts that are at the bottom of the adjusted trial balance. So if we show our revenues and we show all of our expenses, we then come up with a net income of $39.60 for our total net income. Then, to complete our statement of owner's equity, we're going to take two items here. We're going to take on our trial balance the account that says J Blue Capital and the account that says J Blue Withdrawals, plus we're going to take that net income number up here from our income statement. So as you see here in our statement of owner's equity, we start with the beginning balance, which in this case there was none, and then we add our investment in J Blue, which was $400. We show our net income, which came from the income statement, $39.60. We come up with the total. Then we take our J Blue Withdrawals, which is an account from our trial balance, to come up with our J Blue Capital as of the end of the period. Now this figure is what we need to finish our balance sheet. So remember I said the income statement's always the first statement you're going to do, then the statement of owner's equity, and then the balance sheet will be the last statement that we create. The balance sheet basically, sorry about that, the balance sheet basically is the first grouping of all those accounts on the trial balance. We always take all of our assets, put those first. Then our liabilities go next. The owner's equity section of the balance sheet comes from the statement of owner's equity. And again, remember how our assets of $48,760 will always equal the combination of our liabilities plus our owner's equity. So the $7,600 plus the $41,160 equal the $48,760. You see that $48,760 is our total liabilities and owner's equity, and our total assets are also $48,760. So this tells us start with the income statement. From that, move over and complete the statement of the owner's capital. After that, you're going to need that balance to complete the balance sheet. That portion of the owner's capital comes from our statement of owner's capital. So, I don't even think I went through any of this because we went through problems after problems. And what we're going to do, just to kind of finish this off, we're going to take another problem from Chapter 4. Let's see.
From Chapter 4 and Chapter 3.
Chapter 3. I'm sorry. Let's look at problem 6. Now, guys, I don't have a worksheet for you, but you can kind of, just scrabble. What we're going to do here is look at this trial balance for the period as of December 31st. This isn't an adjusted trial balance. This is the trial balance before any adjustments were made. And so we see it starts in the order of our assets. You see they're all listed as debits. Now, then we see this accumulated depreciation office equipment. That is that contra account we talk about, where if we take our office equipment, and then this accumulated depreciation office equipment really shows us all of the depreciation we've taken over the life of this office equipment is $1,540. So our real carrying or book value of that office equipment is really the $9,240 minus the 1540 or 700, right? Then you see the next grouping are liabilities. Our accounts payable, our notes payable, and our unearned service revenue are all liabilities, and they all have credit balances. Then from there, we show our equity section. We've got our B. Cooper capital, and then our B. Cooper withdrawals, part of the equity section. Then, do you see the accounts afterwards? Service revenue and our various expenses are part of our income statement, aren't they? So let's just take a look at this and go through it. The following information is available. We're supposed to open what we call T accounts for the accounts in the trial balance, plus the following: interest payable, salaries payable, office supplies expense, depreciation expense, office equipment, and interest expense. So I'm going to basically go over here. Oops, not 2. 3.
Not 4.
So if we look at 3, basically what we're going to do is create some T accounts. So here are different T accounts we've created. Remember, they told us to start with cash. So if we go and we look in our book at this trial balance, do you see how cash began with $16,500? So we're going to just go and show, just as a T, a balance of a debit, $16,500. Okay? The next thing we're going to do is go back to our accounts receivable. You see how it starts with a balance of $8,250? We're going to go and show accounts receivable, balance $8,250. Then we're going to go to office supplies and show a debit balance of $26.62 that you see right here. Office supplies, balance $26.62. That's all I want you to put in. Just this number right here. Okay? Next, if you look at your trial balance, you'll see something that says prepaid rent, a balance of $13.20. You'll put that in there. Balance $13.20. Next, there's another asset, office equipment. It's a balance of $9,240. We'll show that as a debit. Next, this contra account that goes along with our office equipment is called accumulated depreciation office equipment, and it has a credit balance of $1,540. So as you see here, right after our office equipment, we are then going to create a T account that says accumulated depreciation office equipment, and we're going to show that balance of $1,540. Next, we show liabilities. If you look at that trial balance, you're going to see accounts payable with a balance that's a credit balance of $5,940. So you're going to want to put that on the credit side. Then you're going to have another credit liability account of notes payable that has a balance of $11,000. Next, you'll have another liability account that says interest payable, but it doesn't have any balance, so you're just going to leave that blank. The next one they tell you to make is one called salaries payable. It's going to be blank. The next one is called unearned service revenue, and you should have, if you look at your trial balance, you should have a credit balance there of $2,970. So just put in that $2,970 on that credit side. Next, your trial balance will show a B. Cooper capital account with a credit balance of $24,002. Next, the trial balance shows an account called B. Cooper withdrawals. It has a balance of $22,000. After that, you'll see something called service revenue, and it has a balance on your trial balance with a credit of $72,600. Then after that, you're going to see an account on your trial balance called salaries expense of $49,400. Just put that amount in. That's all I want you to put. Then, after that, you'll see one that says rent expense with a balance of $4,400. Then after that, you'll see utilities expense is a debit balance of $4,280. Then, make a T account for office supplies expense. Make a T account for depreciation expense, office equipment, and make another T account for interest expense. So I kind of went through that really fast. Do you want me to just sit on this a minute so you guys can make sure you put them all in? Are you good? You think you got them all, guys? Okay. Okay. So we have ourselves, we've set up everything we need. They asked us to create T accounts, to fill in these balances, which we did. That's all you need in there right now. But now what we're going to do is we are going to determine what we need to do with each of these adjustments. We're going to talk about it out loud. Okay? And your job isn't to do a journal entry, but I'm going to do one just so it kind of clicks in with you. But what we're supposed to do is determine what the journal entry should be and go post them to those accounts. See what I'm saying? So, think of this. Ending inventory of office supplies is $264. So they're telling us they took a physical count of the office supplies at the end of the year, or at the end of the period, and there's only $264 of office supplies remaining. What does it show our office supplies were on our trial balance?
2,662.
Correct, 2,662. Do you see that we need to make an adjustment? Because we really don't have $2,662 sitting in office supplies. We only have $264. So this is something we need to adjust. We've used up office supplies. So it's no longer an asset sitting on our books. What is it? We reduce our asset and we now have an expense. So guys, if we take our ending inventory, what is 8,250 minus 264? I'll do Excel.
No, it's 2662 minus 264.
2662 minus 264.
Not 82, right.
Thank you, guys.
2398.
So 2398 is really what we need to adjust. So what we'll do is we're going to say office supplies expense is, I'm sorry, what did you just tell me?
2398.
2398 is how much we've used up, haven't we? And we will credit office supplies by the same amount. Because think about it. We don't have that balance they told us. We need to adjust it to reflect 264, don't we? To record office supplies used during the period. Okay? So now I'm showing you this journal entry so you can get a visual of really, whoops, that's not what I want to do. So I'm showing you this so you can visualize what we need to do. We are going to want to debit the T account that says office supplies expense of $23.98. So if you go down to the bottom where it says office supplies expense, we're going to want to put an A in there, you know, as our first journal entry, and we're going to debit $2,398 there. But guys, remember, with everything we debit, what do we have to do? We have to credit. So the next one is to credit office supplies of $23.98. So what we'll do there is we'll go up here to office supplies and we'll put an A over here on the right hand side, the credit side. We'll put an A and we'll put in that same amount, $2,398. Okay? Does that make sense so far?
Didn't the first time I looked at it.
Guys, again, I'll go over and over as long as we need to, okay? And if we don't even get to 4 today, guess what? I don't care. Because it doesn't matter. Unless this really sinks in, you're all going to be lost on Chapter 4. Why am I going to go there for you? Okay? As long as you don't mind, we can take an extra week, okay? You get what I'm saying? I'm here to help. So, now let's go and let's see what else we have to do. B, prepaid rent expired, $440. Okay, guys, I'm going to be honest with you. Some of the wording can be tricky. Like, what's this mean? Does this mean we have $440 of prepaid rent left? Or does this mean $440 of prepaid rent is gone? Do you understand what I'm saying? What do you think it is?
440.
Yes, you're right. But I'm going to say to you, that can sometimes be tricky because you're trying to understand what are they asking me or what are they telling me. But when they say this, that means they're letting you know it's expired, we need to make it rent expense. If they say the prepaid rent that has not expired is $500, then what are we going to do?
That would be your balance.
That would be our asset prepaid rent, and we know the rest would have to be shown as an expense. So that's where I think it can get tricky, to be honest with you, is to know what are they saying to me, okay? And I'm going to make it really simple. And you know me, if it's not straightforward, you'll get credit for it, okay? Because it's hard enough without being tricked, or, having to decipher what I mean. So this journal entry is telling us what to do. $440 of rent, prepaid rent expired. What am I going to do? Guys, I am going to debit. Remember, debit always happens first. And I know expenses increase with debits. Rent expense is my debit of $440, okay? And my credit is going to be prepaid rent of $440. To record rent that has been incurred or expired.
So later on, are we going to get tested on that little blurb that we write?
No.
Because I wouldn't necessarily write it that way. But
no. Okay. You'd probably write it way better than I'm writing it.
no.
Now let's go and post this to the T accounts. Let's go to that T account we call rent expense. And are we going to debit rent expense or are we going to credit rent expense? Debit, $440. So we are going to go to all the way down here to rent expense. Do you see how we already have a balance in there of $4,400? Below it, we're going to put a B, and we're going to show a debit of $440. Okay? That's all you're going to do. Don't do anything else. Now, if we go back to this, we need to post the next part. It's a credit prepaid rent of $440. So now let's go up to our asset called prepaid rent. Do you guys see how we started with a balance of $1,320? I want you to go over to the right of that, put in a B, and show a credit of $440. Okay? That's all I want you to do, nothing else. Now, let's try C. Depreciation of office equipment for the period was $660. What are they telling us, guys?
They're wore out.
It was utilized, or with the passage of, that asset, $660. So let's look at that. What are we going to do here? We're going to want to show a depreciation expense, because that's an expense account and it's always a debit balance of $660. Then we're going to want to show accumulated depreciation office equipment. I'm not really writing all that out because I don't have room. I guess I could make it. Okay? Accumulated depreciation office equipment, $660. Now we're going to go post it. I want you guys to try to figure out where you're going to post these. I'm going to give you like 2 minutes, and then I'm going to see if you did it right. Okay, so if you look at this, depreciation expense, it'd be down here. You should put a C in there and a debit to $660, right? Then the other side of the equation is up here called accumulated depreciation office equipment. You already have a balance in there of $1,540. You're going to, below that balance, put a C and a credit of $660. Okay? How many of you guys make sense? Good. Next, D. Accrued interest expense at the end of the period is $550. What this means is interest on a loan. You know, I wish they would just loan me money for free, but you know what? My looks don't cover it. So I have to pay money on this loan. Get what I'm saying? It's a cost of taking out money. Now, I haven't paid it yet, but I owe it. So I need to show accrued interest expense of $550. So think about this. We're going to show interest expense of $550. Then we're going to show accrued interest payable of $550. Okay? Now we're going to post them. We're going to go down to the T account that says interest expense, and we're going to debit it. We're going to put a D and then a debit for $550. Then our payable should be in the middle here. And, okay, I called it accrued interest payable. You can just call it interest payable. I should have known better. We're going to do it, put a D here. Oh my God. I'm so sorry. I'm sorry.
The was driving me nuts.
I'm sorry, guys. I didn't have it put down. We're going to credit, or put a D here, for interest payable. Okay? Does that make sense so far? Does this help going over more problems? Mm-hmm. Do you think? Next, E says accrued salaries at the end of the period, $330. What that means to me is salaries that have been earned, that are an expense now, but we haven't paid them. Okay? So what do you think our debit's going to be?
Salary expense.
Salary expense of $330. So we're going to debit salaries expense. $330.
And we're going to credit salaries payable.
You rock, sister. Salaries payable, $330. To record salaries incurred during the period but not paid. So we're going to go post them. The $330 debit to salary expense, we're going to go here and we're going to debit. We already have a balance sitting there of $49.4, but we're going to put an E and show a debit of $330. Our salaries payable is going to be an E on the credit side and a $330 credit. Next, service revenue still unearned at the end of the period is $1,166. They're telling us, hey guys, we show unearned service revenue of $2,970 in our trial balance, but it's wrong. It really should only be $1,166. So that's telling us our new balance in this liability account called unearned service revenue should be $1,166. But what do we do with the new the adjustment we do is now service revenue that has been earned. So if we take our $2,970 minus our $1,166, we're going to debit unearned service revenue of the difference of $2,966 minus, what was it?
1166.
11 what?
2970.
2970?
Yeah, 1166 gives 1804.
Thank you. And we are going to credit service revenue. Right?
Yeah.
So let's go and post those. We're going to show in our revenue account service revenue. We already have a balance of $72,600 in there, but we're going to show an F for this journal entry, a credit of $1,804, and we're going to show under unearned service revenues a debit F of $1,804 because we want our new balance to be $1,166. Is that correct? Next, G is our last one. Service revenue earned but unrecorded, $2,200. So we have earned service revenues of $2,200, but we haven't sent out a bill. So what are we going to do? What would be our debit here? What?
The unrecorded revenue?
It would be accounts receivable because we're going to get that money. And it was how much, guys?
2,200.
And we are going to credit service revenue of $2,200 to record revenues earned but not yet billed. Then what we'll do is post these. So we'll go into our accounts receivable, post a debit to $2,200 accounts receivable, and then our credit to service revenue of $2,200. So if you go up here, you see our accounts receivable here? We're going to show a G and a debit of $2,200. And then we go down here to service revenue. We're going to also, in our credit side, show a G of $2,200. Now it says to us, prepare an adjusted trial balance. In order to prepare an adjusted trial balance, we need to come up with new balances in all these accounts. So what we want to do is those that have more than one entry in them, we're going to need to create a new ending balance. You see cash, we only have one balance. It's just the beginning balance. Nothing else was adjusted. So we don't need to do anything there. But with accounts receivable, because both of the entries in this T account are to debits, what are we going to do to create a balance here? Add it. With office supplies, it's an asset which has normally a debit balance. If we start with our balance and then with that credit we need to subtract, we should come up with a new office supplies balance of $264, which is what we know we have in ending inventory in office supplies. Our prepaid rent, we started a balance of $1320, and we have to subtract from that our $440 journal entry to give us a new balance of $880. Our office equipment didn't change, but our accumulated depreciation on our office equipment changed. It's a normal balance here of a credit balance because it's a contra account. If we add those two up, we should have a balance of $2,200. Our accounts payable, nothing changed there. Our notes payable, nothing changed there. Now we have interest payable, but we only have one figure, so that's our ending balance. Same with salaries payable. Our unearned service revenue is a liability account, and it has a normal credit balance. So we need to take the original balance and then from there subtract our debit to come up with a new balance, which is what we knew was supposed to be in the books. They told us. Our B. Cooper, nothing's changed there. The withdrawals, nothing's changed. The service revenue, we started with a balance and we have two entries we added. And you add all that up, it should give us a new balance of $76,604. With our salaries expense, we started a balance of $49,400 and we increased our adjusting entry, increased $330 for a new balance of $49,730. Rent expense, same thing, a debit balance, and then we had an adjustment to have a new ending balance from rent expense of $48.40. We didn't do anything with our utilities expense. Our office supplies expense, we didn't start with a balance, we just added one item, so that's our ending balance. Then depreciation expense on the office equipment, we created an adjusting entry, which gives us a new balance there. And then interest expense, we have a new balance there of $550. So once we come up with our new balances, we're going to create a trial balance just like the one in the book. But we're going to have a couple more accounts than what the book has. We're going to just go down those T accounts. Each T account, we're going to just write the account in. And if it's a debit balance, we're going to put it on the debit side or the left side. If it's a liability or a contra account or service revenues or capital accounts, we're going to credit them. We're just going to transfer it exactly as it needs to be. And we should in the end see that our debits of $121,792 are always going to equal our credits of $121,792. Okay? Does that make sense? Okay, I'm just going to take this a step further. What if we're told to do an income statement? I want you to take 2 minutes. I'm going to run to the restroom while you do this. I want you to take 2 minutes and I want you to construct an income statement, and we're going to see who's right.
You're going to leave.
So Brave Advisors Service.
Is that what your name is?
What?
I didn't read that part.
Income statement for the period ending December 31st, 2014. We're going to start with revenues. Service revenues of how much? 72,600. Then we're going to come up with our expenses. What expenses do we have?
Salaries of $4,940.
4,940.
Rent. $4,400.
4,400.
Well, maybe that's not right because of the
Rent expense is 4,840.
okay.
Yeah, your numbers are off because the revenue should be 76,604.
Thank you.
76,604.
Yeah.
And guys, the truth is, when you're dealing with computerized software, you don't make those mistakes, okay? And the rent expense is, what did I say, 4,840. 4,840. What's
Salary expense should be 49,730.
49,730?
Yep, not 630, 730.
Thank you. That's okay. Next
Utilities
should be
4280.
4,280. Next,
$23.89.
for what?
I don't know.
Office supply
I know it's
expense.
an expense.
Okay, supplies expense,
98.
There you go.
2398. Next,
$660.
for what?
Depreciation
Okay.
expense, office equipment.
And $550.
And what was the 550?
Something expense, interest expense.
Interest expense. $62.
448.
448 or
458.
okay. Then our net income,
76604 minus the 62,458.
or 14,146. Does that sound right?
I didn't have it right, but
It's okay.
sounds good.
Guys, thank God for software. That's why do you think I use Excel? So that's how we would create an income statement from the adjusting trial balance. Now what I want to do is we're going to create a statement of owner's capital.
I gave you some cheat sheet.
Cheat sheets are great. So,
Statement of owner equity, same thing, right?
yeah, statement of owner's equity. So what we're going to do with our statement of owner's equity is, I'm waiting till you're done, darling. Are you done? Yeah. Okay. Now, statement of owner's equity, we're going to start with what?
The cap, what's this?
B. Cooper Capital,
B. Cooper Capital.
24,002. B. Cooper Capital, 24,002. Okay? Then what are we going to do? Go to your cheat sheet.
Our net income.
Our net income. He didn't make any investments. Our net income is going to come from here.
The 14, yeah.
And then we have a subtotal.
And then he withdrew.
Then we're going to show B. Cooper withdrawals.
And that was 22,000.
Very good, yeah.
Then we're going to have B. Cooper Capital 12/31/2014. Should be 16,148, shouldn't it?
Okay.
Make sense? Now what I want you to do is you're going to need this figure right here in our balance sheet. Okay? So write this down. But we're going to do a balance sheet. Now I'm going to put this information back up. You're going to use all the assets and all the liabilities. And guys, you're going to stop. After salaries payable, you're going to stop. I'm letting you know, excuse me, not after unearned service revenue, you're going to stop. You're not going to use your Cooper Capital because this is not the true balance. We want to use the balance from the statement of owner's equity.
16,140, yeah.
So basically, I want you to start here, and I want you to go all the way down to unearned service revenue. Now, you look at a balance sheet. What page is a balance sheet on?
100.
I want you to look at 100, and I want you to create a balance sheet on your own for a couple minutes here. Okay? Just one sec. So we've already done some of the balance sheet here. Forgot to put it back on. And as you see, the big thing here with the assets is we have to take the office equipment less that accumulated depreciation to come up with a new carrying value or book value on our office equipment of $7,040. So we're just to a place of totaling our total liabilities of $18,986. Then from there, we're going to do our owner's capital,
16,148.
16,148. Now we have total liabilities and owner's capital should equal that plus our liabilities, 35,134. So it works perfect, and that feels so good to balance it. Any questions on this? This really encompasses everything we did with Chapter 3. Does it make sense? Yes.
So with the 7,040,
Yeah?
that's just the credit of the office equipment minus the depreciation, right?
It's the debit of the office equipment minus and adjusting it with the accumulated depreciation gives us the new carrying balance. And why we do that is I'm sorry.
I was just wondering why you did it on the left and the B column.
Because if you look at, really, you can do it however you want, but if you look at other income statements, oh, here's one. Do you see how they do it? They put it over here, and then they'll show like limousines less accumulated depreciation to just put the real balance here.
Oh.
Does that make sense?
Okay.
It just kind of makes it easier to read.
Yeah, when I wrote that problem, actually, I put the 150,000 down, and then I put an arrow up, because when I looked at the answer sheet, they had 150,000 on the way. So I had to show that those were the same numbers.
Okay.
So basically, what we have done in this chapter, we have learned how to adjust certain entries. We've learned then how to post them, how to create an adjusted trial balance, and then from there how to make all our financial statements. I mean, we've done a lot in this chapter, okay? Now Now, we can do one of two things. We can go over another problem in this chapter, or we can move on. What do you want to do? Celeste, you be the boss.
I'm ready to move on.
And you're ready to move on. So what I'm going to do is, in this lecture,